Welcome to the webinar titled Risk Management in Forex and Why It Matters, brought to you by iFOREX. Let's go through the agenda. What is risk? We're going to define risk. And then, of course, we're going to find rules that will allow us to mitigate the risk or risks. Then we're going to touch protective stop loss. Yes, protective because it protects our capital. Then we're going to calculate our position, the position size that is. And we're going to talk about maximum drawdown and reward to risk ratio. So, what is risk? Risk is the potential of a bad outcome. What is a bad outcome, nevertheless? So, it's the potential of underperforming. Say that a fund manager expects to make, for example, 10% return per year. But this year, the return was only 2%. Is it good for his reputation? I would say no, right? So this is a risk of underperforming. Another bad outcome might be for traders that expect to make a certain number of pips per day, per week, per month, per year, but they fail to achieve these goals. This is another bad outcome. And of course, we will all agree, and it's obvious that a risk is the potential of losing money. And this is what we're going to discuss today. So, there are three essential ingredients when trading the financial markets. First is a trading system, a robust trading system that we have tested and we trust. This is very important. Then, of course, we need some risk management rules to mitigate our potential risks. And of course, we need the psychology, the mindset, the discipline to follow the trading system and the risk management rules. Everything together is what I call a trading formula. So we need chart analysis. We have to know how to analyze the price chart so we can identify the prevailing trend or the trading range, if there is one. We need precise rules when to enter, exit the market, and of course, risk management rules, and the discipline to follow everything. Without discipline, then we are in trouble. So, analysis, we use chart analysis to identify the prevailing trend in the market. So we decide whether we're going to buy or sell based on our chart analysis. Then we need a trading system with precise, detailed rules when to buy, what to do. Are we going to buy? Are we going to sell? Right? Are we going to book our profit or are we going to exit with a small loss? So a trading system will let us know when we enter the market, either with a buy or sell order, and when we exit, either with profit or a small predetermined loss. Risk management, we're talking about the size of our trade, stop loss, and take profit. Very important rules. And of course, once again, we need the discipline to follow these ingredients, analysis, trading system, and risk management rules. So we need to place a stop loss, a protective stop loss. This is our risk management rules. We need to calculate our position size based on our profile. We need to know our risk to our reward to risk ratios, or risk to reward. We can use these terms interchangeably, reward to risk or risk to reward ratio. And what do we do in periods of success when we make profit, or adversity when we lose money? Do we double? Do we triple our position size, or do we reduce it? So we have to know what we do in these special cases. So let's talk about the protective stop loss, the stop loss. If we do a very fast chart analysis, we can agree that this is a beautiful downtrend as defined by successively lower tops and lower bottoms. So this is a downtrend. And then we can identify here a reversal as defined by this bottom that failed to go lower than the previous bottom is supposed to do in a downtrend, and then prices surpass the last top. So this is a reversal here, and based on our trading system, we're going to buy right above the top. At the same time, we have to place a stop loss right below the most current bottom, right? So this is our stop loss, our protective stop loss. And in this case, since we're using technical analysis, chart analysis, I call it technical stop loss at the most recent bottom. So we can introduce here targets, profit targets, that is. So again, once again, a downtrend is defined by successively lower tops and bottoms, then a reversal, we enter right above the top, protective stop loss right below the most recent bottom, and based on our system, profit target is right here. We can book all our profits here at target 1. So another variation of this is that we can close 50% of our position at target 1 and then move our initial stop loss to our entry, so we have a break-even point if and only if the market moves against us, right? So this way we can safeguard our profits and our capital. So stop loss rules. It's very important to have a protective stop loss in our system. We plan in advance, we know in advance where to place our stop loss and how much we're going to lose in case the market moves against us. And we place the stop loss when we enter the market, right? We do not wait, and we do not wait for our psychology to affect our decision making, right? It's extremely important that when we enter the market, we know exactly where we're going to place our stop loss, and we place it. We do not move the stop loss due to fear. This is extremely important. I've seen it in many cases. A lot of my students complain that they lose their psychology, their mindset. They are disciplined and they move the stop loss because of that and because of fear, and they end up, unfortunately, losing money and eventually their own account. So we have to place a stop loss and we have to honor our stop loss so we don't move it. Why? Because we want to protect our capital. We pre-calculate how much we're going to risk in any trade, and so we know in advance our risk and our reward. So position size, how to calculate our position size. Let's take an example here. Say that our entry is at 1.3025 and the stop loss is at 1.2975. If we do the subtraction, then we have a risk of 50 pips or 0.0050. This is 50 pips, right? So this is our risk. Let's do this example. Say I decided and I deposited in my account $10,000. Now, the question is how many trades you want to make with this amount. Say 50 trades, right? If I divide $10,000 by 50 trades, then it boils down that I'm going to risk $200 per trade. That is 200 times 50 is $10,000, right? This is the algebra here. Now, the entry in the specific example is 1.3025. The stop loss is at 1.2975. We do the subtraction. Pips at risk, this is how we call it, is 0.0050. This is 50 pips. Right. Now, how do we go about calculating the position size? Simply divide $200 by 50 pips in decimal notation. So the equation is $200 divided by 0.005 is equal to the position size, to $40,000 in this case. Good. So the formula is position size equals risk per trade divided by pips at risk. Let's go to this example where the trader decides that they want to trade 100 trades instead of 50. So if we do the maths, $10,000 divided by 100 trades is $100 risk per trade. The entry point and the stop loss is the same, so the pips at risk are 50 pips. So we do the division, $100 divided by 0.005. The answer is $20,000 position size. Clear, right? So let's move to the next example. Now we want to make 125 trades based on our $10,000 deposit. Again, the entry and the exit is the same. Exit meaning the stop loss. It's 50 pips at risk. And if we do of course, the risk per trade is 80. If we divide $10,000 by 125 trades, then we get $80 risk per trade. Now, we divide $80 risk per trade, $80 divided by 0.05 pips at risk. The answer is $16,000 as a position size. One more example. Now, the trader decides that they want less trades per $10,000. So 40 trades. Now the entry is the same, but the stop loss is different. It's a different trade, guys, right? It's a different trade. So we have 20 pips at risk and $250 risk per trade. How come we get 250? It's $10,000 divided by 40, right? Then the pips risk per trade is $250. Now divide $250 by 0.0020 and the position size is $125,000. Good. Let's talk about maximum drawdown. This is a table that was created, developed by Mr. Wells Welter, a very popular technical analyst, by the way. So say that our initial deposit is $100,000. Say now that we lost 5%. That is, we are left with 95,000. Good. So we need 5.26% of the remaining so we can break even. Can we make it? Perhaps, right? So now let's say that we lost $10,000, 10%, pardon me, say that we lost 10% and we are left with 90,000 as a balance. Now, we need 11.11% of the balance so we can break even. Can we achieve that? Maybe. If we lose 20%, then we need 25% to break even. And it goes on like that. So if we lose 50% of our initial deposit, then we are left with 50,000 and we need 100% of our remaining capital so we can break even. Imagine the pressure that we will be having, and our discipline perhaps will be compromised. And if our discipline is gone, then the result, the impact will be on our account, right? So it's extremely important to be careful with our drawdown, with our losses, right? So I'm sure you heard this saying, let profits run and cut losses short, right? So if there is a strong trend, we can allow our profits to run higher. And if we lose, we can cut our losses short, meaning that we do not move our stop loss because of fear. I've seen that many times. We honor our stop loss. It's a predetermined number. We pre-calculated our risk per trade and we have to honor it. So it's very important to cut losses short. So winning trades will outweigh more losing small trades, right? So we want larger profits and smaller losses. A commonly used reward to risk ratio is 3-1. Of course, you can adjust it as per your profile. Let's have an example here. Again, this is a downtrend and a reversal here. So we decide to enter at 1.3580 with a buy trade, and right away we place a stop loss at 1.3550, right? The difference is 30 pips. Now, we risk 30 pips. Our reward, if it's 3 times, then it should be 90 pips. So now we can calculate our take profit level, which is 90 pips above our entry, right? Excellent. So this is our reward to risk ratio. This is what I had for you guys. I hope you enjoyed it and learned something new. Want to understand markets and technical analysis better? Follow iFOREX for more quick and easy guides to trading. Stay tuned for more.